welcome to another brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, experts say that the starting point in financial planning and creating wealth is setting your financial goals. Do we give enough thought to this, or are we simply chasing returns in search of having one large pot of gold by the end of the exercise? How do you fix your goals with life being ever evolving and very dynamic in today's fast-paced age? So goal setting and flexible planning to meet changing life needs, that is what we're discussing on the show today. And I have with me Gurmeet Chadha of Complete Circle Investments, as well as Sandeep Sharma of SBI Wealth Management to take up this very interesting issue. Gentlemen, thank you so much. It's great to have you on. Sandeep, thank you so much for coming to the studios. And Gurmeet, hi. I know you're there in New Delhi, so, greetings from Mumbai. I must ask like a blasphemous question at the start. Sometimes I wonder, and I've had conversations with a lot of my younger colleagues and peers around, right? They say, what is this goal-setting business? Life is changing. I don't know if I'll have my job tomorrow. Maybe I want to take early retirement. Maybe I want to travel the world. I don't know if I'm getting married or not. What are you talking about, this long-term goal, 15-year roadmap? So is the concept getting a little outdated? I start with this, as I said, slightly blasphemous question to the planners. Sandeep, your thoughts?
Okay, thank you for calling us, Surabhi. So basically, see, goal planning is important in my view, primarily because, life events are going to happen to you, whether you plan for it or not. So you are going to retire one day, you are going to get married. If you get married, you're going to have kids, then you're going to plan for their future also. You need some kind of a contingency planning because, life is not that simple. So therefore, it's better that if you are able to define the goals that you can foresee, it is always better because it makes your investment journey more smooth.
Okay, all right. So life will happen anyway, so you might as well start planning. Gurmeet, come in on this, and that's really the opening question because a lot of people are now saying my life is so dynamic. It's not like the older days, right? Get married at 28, have your children at a certain age, retire at a certain age. It's all over the place now. So how do we plan?
So, Surabhi, there is a famous quote that goal without a plan is just a wish, right? And wishes may or may not come true. So you need to quantify them, right? Especially when those are financial goals, right? So when you quantify your goals, you start seeing the invisible future in the present, right? So you have to quantify, things like, as you rightly said, getting married, buying a real estate, planning for your children, planning for your retirement. Once you do that, then you also start penning. Once you pen down things, you also pen down, okay, how much money do I need to, fulfill that wish? Second, do I have enough resources to fulfill that wish? Most importantly, when you do that, you're also accepting that I'm not just trying to, wish things. I'm trying to put a plan to action. So only by specifying and quantifying, I think, 50% job is done. And once you do that, you also figure out what are the avenues which will lead you there. So the first step is always quantifying. And that is why, look, even the government of India also does it. They come up with a union budget every year. Otherwise, everything is a wish list. I will give houses, I give toilets, I give this and that. But only once you quantify, you realize, okay, I have limited resources. Let me now put optimal use of it.
Okay, fair enough. I mean, that's a strong argument that you make, that at least you have to start somewhere. You have to have some plan. The question then is that, what shape, form and format should this goal and this plan take, Sandeep? And what's the advice that you give out? You've been in the financial services industry for so long, right? So whether someone is single or married or middle-aged or, heading towards retirement, what is it that you need to start asking yourself? What is it that you need to start quantifying, like Gurmeet is saying, and putting down on paper?
So basically, I think you have to start with identifying the goals. So there can be various goals that one person can have in his life. So once you are aware that what are the goals and what are the timelines, then you start creating some kind of an asset allocation for that person. What I have also realized is that, if you attach an investment to a particular goal, then probably your journey becomes very, very easy. Okay. Because, we have a monkey mind, we have our own biases, each one of us. And what it leads is whenever there is a drawdown in the market, probably you're compelled to take a decision which is not good for your financial health. So if you have a plan, if you have a timeline, and then you are doing your investments, then this journey is very smooth.
Okay, fair enough. Gurmeet, one more point here that I think I see a lot of people debating around me, and that is whether I should really have so many different buckets: vacation, car, house, home renovation, buying the next iPhone. It could be anything. Whether you need to keep bifurcating in smaller sort of buckets, or whether it's just better to be systematic and disciplined and look at creating, like I said, one large pot of wealth from which you can keep allocating. So, I mean, two different approaches. What do you think is the right one?
Yeah, so, there's no one size which fits all, but, there's some broad rules or broad framework you can follow. I follow a framework for myself, which is 12-month, three buckets, right? And so 12-month, I mean, 12 first for me is an emergency bucket because as Sandeep said, life is uncertain. So I need to have an emergency bucket in place, which is money may I need if I tomorrow lose my job or undergo losses in my business, or there is let's say, serious family illness. So anything which is unforeseen, I need to have 12 months of expenses in a bucket. We call it an emergency bucket. And then you have three types of buckets. One is the short-term bucket. Now, this is a bucket which is yours, any short-term goal. Let's say you want to buy a car, you want to take up a nice vacation a year, a couple of years from now. This bucket has to be more risk-averse because, the goal is pretty near. And over 1 or 2 years, the markets could, be very fluctuating. So you want a bit of a surety of returns. So this bucket should go into fixed income. It could be bonds, fixed deposits, arbitrage. Second is a medium-term bucket. Now, medium-term bucket could be something which is 3 to 5 years from now, where you can have some kind of a site, but not a very long horizon. It could be, let's say, a house you always wanted to buy. It could be a startup dream you have. Let's say you want to start something on your own, and you have, let's say, plan for 3 to 5 years. This bucket could be a combination of, equity, bonds, gold, something which delivers better than fixed deposit. So you can call this as a hybrid bucket also. And the last bucket, as you were mentioning, is your long-term bucket, which is where you need to beat inflation seriously, where you need to really deliver, double-digit returns so that you can build your retirement coffers, you can build a huge wealth for you as well as generational wealth for your family, which predominantly should go into equity. And if you have some insights on real estate, maybe that as well, but that should predominantly go into equity. So we say 12 months, which is emergency funds, and three buckets, which are short, medium term, and long term.
Okay, so first set your sort of emergency corpus, and then have your three buckets of short, medium, and long-term goals. Got that. Sandeep, come in on this. Is that the approach that you'll also follow? And typically, when it's like I said, now buying an iPhone could be a short-term goal because you want it obviously as of yesterday, or you want it in the next 6 months. But the trouble, I guess, there is, like Gurmeet said, that in an ideal world, because it's short-term, maybe that money is going to be parked in short-term assets. But they might not give you the return. Now, if I say 6 months I'm putting my money in, let's say, a fixed income fund, I doubt I'll generate the 1 lakh rupees that I need to buy the iPhone. So how do we deal with this mismatch?
So this mismatch is always going to remain. The only solution for this is that you need to have money in your pocket when you're going out to buy. But that's an ideal situation. But, let me just, try to tell you that, of course, if somebody is having a goal which is only, say, 1 year away, then definitely in today's market, I think I will only suggest an arbitrage fund. Now, where you can only get about 6.5%, not more than that. So therefore, there is no easy answer for this. The only thing that I can suggest is that if you plan well, even if you are want to buy a mobile phone, then maybe if you're buying an Apple, then you can plan it out, maybe 18 months, 2 years in advance, that maybe, I'll have to, because that's the only way. There are no shortcuts. You can't really create disproportionate money. And as Gurmeet mentioned, you cannot take that equity risk at all. Not even a hybrid fund probably you can invest in.
If any Gen Zs are listening to our conversation, I hope they heard you, right? So if you're thinking of an iPhone, think of it at least 15 months to 2 years in advance and start investing and sort of saving up for it as well. Which brings me to another question, gentlemen, and I want to sort of take up an example as well. And I think this is something that people grapple with. When you're talking about some of the short to medium term needs, like let's take the example of buying a car, right, Gurmeet? The option is, or a home renovation. Let's say you need about, 5, 7, 8 lakhs for home renovation. The option is taking personal loans or car loans or some of these, home improvement loans versus having planned for it and having sort of invested for it. Now, what should one look at, and how do you toss the coin between taking that loan at 8, 9, 10%, and the other approach being, of course, investing and being very prudent? So, how would you look at meeting both ends, Gurmeet?
Yeah, so we use a term. I'm a banker. Asset liability mismatch. This is a favorite word RBI governor is using these days. What led to the NBFC crisis? They were borrowing short and lending long. Right? They were borrowing money at DHFL and IFLs of the world. ILFS. Was borrowing for 6 months, 1 year, and doing mortgages which were 10, 20 years. So that's what if you can't invest in equity for 1 year goal, 1.5 year goal. Because at the time of drawdown, market could well be down 20, 30, 40%. So never do asset liability mismatch. That's why asset is very important to bucket it. And that's why time plays a very important role, and your risk awareness plays a very important role. So for short-term goals, number one rule is avoid impulsive purchases. I suddenly like a smartphone, I like a swanky SUV car, let me take a loan and buy it, right? I think that's the number one mistake you do, because you're buying a depreciating asset. Let's say you buy today a car, which is, let's say, an SUV of 25 lakhs, and you pick up a 20 lakh loan. You finance it 70%. The car after 5 years would be half of the value. And the amount you would have paid would be doubled. So you ended up basically eroding 75, 80%, of the asset by leverage. So some bit of leverage is fine. There can always be some short, you can leverage 10, 20% as long as interest rates are reasonable, and, you might have a small part of it. So for short-term goals, plan for it. Do not take extra risk. Avoid excessive leverage. I'm not saying just save everything for retirement, because a lot of people say, what's the fun in hiking and when I'm 50 years of age, right? Or what's the fun on going on vacation when I'm too old? So that's why striking the balance is important. Less leverage, or ideally avoidable, less leverage. Short-term goals should be financed by your savings and conservative instruments.
I think an important takeaway is that a short-term goal doesn't mean that it's so short-term that you can achieve it in three weeks or 3 months.
Yeah.
Short-term means that the time to achieve that goal is coming nearer. So even if it is that vacation or that iPhone, it doesn't mean that magically you put money in equity market in 3 months you can get that iPhone. I think that you really drive home that point. That's really important. So let's come to asset allocation, and we'll just put up a chart which kind of gives a general sense of returns that different asset classes have thrown up. This is, of course, historical data, just for reference. I mean, future returns are obviously not guaranteed by the past performance. But just for reference, if you're looking at equities, this is, of course, Indian equity, US equity, the 5-year return obviously is 19-20%. But if you look at longer term, 15 year, so 13 to 19% is the kind of equity return. Debt has given over 5, 10 and 15 years between 6 and 7%. And gold is hovering between 15% to 10%. I mean, that's the kind of range that gold has delivered in the last sort of few decades. So that's just a reference point. Now, gentlemen, let's come to the task of marrying, like you said, that, okay, we fix the goals, house in 5 years or car in 3 years, retirement in 20 years. We fix the goals. Now, how to marry that with the right asset class that we are investing in? Sandeep, your advice.
So in terms of, your long-term goals, definitely you have to overexpose yourself to equity. Again, this is very different for different individuals. It depends upon where you are in terms of your life cycle, what kind of a savings you have already, created for yourself. So that becomes a very important point for you to start with. If you have a lot of savings with you, then you can, think about equities, exposing yourself to a lot of equity, then there is no problem. But yes, when it comes to a stage where you are trying to build up and you don't have some kind of a corpus available, then there you need to probably allocate to equity and a portion of money to liquid. But if you have taken care of your, your emergency needs and all, then probably, I feel that for a normal person, 80-20 kind of an exposure to equity and debt would be a good starting point for a long-term portfolio. Okay.
Gurmeet, your thoughts on this, the right asset allocation blend, and just if you could give some examples as well. I mean, like we said, if it's a vacation versus if it's a longer term goal like retirement planning, then.
Sure. Right. So, as Sandeep said, it's important to quantify first. Typically, let's say you first start with a figure. We say about 25 times your annual expense should be your retirement goal. Typically I'm saying, for example, let's say my annual expense is, let's say today, 12 lakhs, which is, let's say 1 lakh a month. Okay, so my retirement purpose has to be at least 3 to 4 crores, right? Which is 25 times of 12 lakhs. Now, 3-4 crores today, let's say 20 years down the line, would probably be 15 crores, right? So once you do that as a figure, since I've been talking of retirement first, because that's the most long term you have, and I'm assuming you are, let's say, either have started your career or somewhere in the mid cycle. So then you work on calculation that how much do I need to put for 20, 25 years to get. So that's your long term thing. For medium term goals like a house or something, you will have a multi asset allocation. The advantage of Surabhi doing this is you figure out that, okay, this asset class works here. You also get away from speculative thing. You stop predicting markets. So once you do asset allocation, you are accepting that future is uncertain and I need different asset classes which will do well across different periods of time. We are so consumed by best returns that we forget that this is to optimize, not to make the best returns. And optimize means also managing risk, managing your cash flows, managing drawdowns, right? So midterm goals can be a combination of equity, gold, bonds, and short-term goals I already mentioned that has to be more conservative. So it's like your lunch thali. Your equity is your protein, gold is your fiber, carbs, which is your basic roti, is your debt.
Okay, that's well explained. Sandeep, just a point on multi-asset funds, and we're discussing asset allocation, right? I think this is also something that people often think whether they should do their own portfolio level asset allocation, that, okay, I have 70% of my money in equity funds and 20% in fixed income and some in gold, or whether they should opt for this product called the multi-asset fund, which most AMCs are offering. What's your advice?
So basically, in a mutual fund structure, the tax benefit is humongous. Okay. Because, today probably we are trading at a higher end in terms of the valuations in the equity market. Now, probably right now, multi-asset allocation funds will have limited equity exposure, anywhere between 25 to say 35, 40%. But when the time changes and when the time comes to increase equity exposure, the fund manager will be able to increase it without any tax impact. So that's a very big advantage.
Yeah. Whereas for us, individually, I'll have to first sell down my equity funds, then look at investing in fixed income or any other asset.
And multi-asset allocation funds in today's scenario are very take to gold and silver also. So I think today the most aggressive product that we are investors is either a balanced advantage fund or a multi-asset allocation fund.
Okay, got it. Well, we'll take a quick break on viewer queries as well. We'll come back with the answers in just a moment.
Let's talk money.